Hello, everybody. Welcome back. My name is Arias, and this is my show. Today, we're talking about IPOC and Clover Health. Let's jump right into it.
First, let's talk about their opportunity to disrupt the Medicare Advantage healthcare market that they play in. First of all, the American healthcare market is huge with a market size of $3.65 trillion. That's 18% of our GDP. Second, healthcare costs in America have skyrocketed over the past few decades, growing 31 times or 6 times on a constant dollar basis. With all of this cost, you'd expect to have better healthcare in America. However, we lag in life expectancy over other developed countries. Americans also suffer from higher rates of chronic illness as we age, with 28% of all Americans and 68% of Americans over 65 having 2 or more chronic conditions. Despite these relatively poor outcomes, health insurance companies have still seen massive returns over the last 10 years. What's crazy? The largest 3 health insurance companies have actually generated superior returns to Facebook and Google over the past decade, which runs completely counterintuitive to all of the hype around FANG stocks. These leading health insurance companies have about $500 billion in market cap and have historically added to it by about $50 billion a year. However, this is still not a mature market, and in fact is exploding in size, as about 10,000 people age into Medicare every day. Now that we have talked about the market they play in, let's talk about the company itself. As of today, Clover offers Medicare Advantage plans, which are essentially extra healthcare to those who would have otherwise taken original Medicare. They are starting in the 65 plus market because by providing superior care here, they can have the most impact for this age bracket. They look to make their plans the obvious choice to the consumer as they have broad consumer choice and the access of a PPO with the lower cost of an HMO. Now, what really makes Clover special is their Clover Assistant. The Clover Assistant uses machine learning to provide helpful information and suggestions to physicians that deliver better patient outcomes at a lower cost. While they are still early in its refinement, its effects are already observable with Clover patients having 22% fewer hospital visits and 23% fewer ER visits. Finally, direct contracting offers huge upside for Clover, but we'll talk about this in greater detail later. Let's talk a little bit more about the Clover Assistant. Like I said, the Clover Assistant improves the quality of care that physicians give to their patients with machine learning. Now, this sounds simple and like it would be easy to copy for another startup. However, much of the necessary data is siloed in hard-to-reach places, so it is tough to get the data needed to train a system like this. The best way to get all of this relevant data is to be the insurance provider, where you can access everything that happens to the patient. Now, you may think that an insurance company would copy this, but I think this is unlikely as well, because they lack the necessary expertise. From the physician's point of view, who uses the Clover Assistant every time a patient comes in, it has a very high Net Promoter Score, and it also pays out much faster than competing platforms, which encourages physicians to sign on and use it. Now, the value that I see in Clover comes down to this. The Clover Assistant lowers the cost to provide better care to patients. Lower costs and better care will help Clover acquire more patients. Additionally, patients give more data to train the Clover Assistant further, which again lowers costs and gives better care, setting us up for a virtuous cycle. Here is that virtuous cycle visualized. Starting with the data and applying machine learning to drive better care and economics, which leads to market share growth, which provides more data and back around again. That represents the incredibly valuable growth opportunity for Clover going forward. Clover is going public via Special Purpose Acquisition Company, or SPAC, IPOC. IPOC is managed by Chamath Palihapitiya. And let's talk about him for a second because he's very important in this deal as well. He's pretty famous and always gets a lot of attention when he goes on CNBC. He was in early days at Facebook, and he's a very intelligent individual, and you can just hear that when he talks. He's built up a lot of clout with his past bets on Bitcoin, Amazon, and most famously Tesla. His company, Social Capital, has the goal of democratizing the IPO process by using SPACs to allow retail investors to get in earlier on companies, and he has reserved IPO A through Z to do this. His company, Social Capital, has the goal of democratizing the IPO process by using SPACs to allow retail investors to get in on companies sooner, and has reserved ticker symbols IPO A through Z to do this. Finally, he aligns his incentives by investing his own capital into the company, but we will talk more about the deal structure later on in the presentation. Chamath has 6 SPACs so far. IPO A merged with Virgin Galactic, a space company, in 2019, and they have enjoyed a nice return so far. His second SPAC, IPO B, recently initiated a merger with Opendoor and is up over 100% already, and has been up as much as 145% recently. IPO D, E, and F are all trading but have not announced merger targets yet. So one of my biggest questions before I invested in IPOC was, why has it lagged in comparison to IPO A and B? I think it has lagged simply because it is a boring company compared to a space tourism company or an online home buying service. I've also heard people were expecting something more in the climate industry, which investors also seem to have much more enthusiasm for at the moment. I've also heard that this merger is desperate, but I cannot find much base to this claim whatsoever. When it comes down to it, Clover is not the same explosive growth opportunity that Tesla is, but this does not mean it can't still generate outsized returns. Let's get into their financials. Their covered lives are growing quickly as they take about half the new plans in their established markets. They grew from 40,000 lives covered in 2019 to projected 273,000 lives in 2021 and 589,000 in 2023. Make note that these projected numbers do include direct contracting lives. The total Medicare Advantage market is projected to over double from $270 billion in 2020 to over $590 billion in 2025, which is a giant market for Clover to grow into. Their revenues are growing fast from $462 million in 2019 to a projected $880 million in 2021 and to a projected $1.7 billion in 2023. For reference, if they hit those estimates, it would be a compound annual growth rate of about 39%. Those estimates, however, do not include any revenue from direct contracting, which, as you can see from the total lives estimates on the left, will take up a vast majority of their lives in 2023. Management has said they can see a path to $25 billion in revenue in 2030 from Medicare Advantage alone, which would justify a massive valuation boost from here, which could further be expanded on by the direct contracting opportunity. Now let's talk about direct contracting. To do that, I will need to explain a bit more about how Medicare works. At age 65 in America, you have a choice of either paying for Medicare Advantage plan, like those that Clover offers, or signing on for Original Medicare, which is federally run. Direct contracting will significantly expand Clover's addressable market by 2 or 3x by allowing them to sign on with physicians to provide for their original Medicare patients. The details should be released by later this year or early on in 2021, where Clover already has 200,000 lives signed on. They add these lives at extremely low incremental cost because they just sign up the physicians, who then port their original Medicare plans over to Clover. This presents loads of upside. Now let's talk about their management a little bit. Their CEO is Vivek Galapari, who has been involved in the creation of 2 other billion-dollar healthcare companies. When you hear him talk, he talks about the right things, in my opinion, and seems to understand the company and have a vision for where it should be going. However, there is an ongoing controversy about a company that he is involved in, Clover Health. From what I understand, it is a group of hospitals in New Jersey that he helped rescue from financial trouble, but it is still unprofitable despite them jacking up the prices. Worst of all, there are some allegations of siphoning off money from the company. Another weird thing is that New Jersey, where these hospitals are, is Clover's most developed market. Maybe something fishy could be going on there, so it definitely deserves more of your own research before investing, but I think it may well be worth the risk because of the upside this company presents. Moving on to the Chief Technical Officer, Andrew Toy, who is the technical mind running the development of Clover Assistant. He ran a team working on Android at Google and appears very qualified. Let's move on to Clover's valuation. At the close of the deal, it will have an enterprise value of $3.7 billion, which is 4.2 times estimated 2021 revenues or 2.1 times estimated 2023 revenues. It has a market cap of $4.4 billion post-merger. The merger includes a $400 million pipe directly from Chamath and his partners, so he has skin in the game as well. He also gets an additional 4.7% ownership for executing the deal, so there definitely is an incentive for him to close the deal. They expect the deal to close by the end of the first quarter 2021, and it will leave them with $668 million on the balance sheet. Finally, it values Clover at 0.96 times estimated 2025 revenues, and that does not include any revenues from direct contracting. This indicates significant upside, and here's why. Their competitors are valued at roughly 1.31 times revenues, but I think that Clover would deserve closer to 2 times revenues, as they would be still growing much faster. And with the majority of their covered lives being direct contracting by 2025, it's easy to see them doubling their projected revenues. This is all speculation, but that would give them 4x upside from here in roughly 4 years, equal to about a 40% compound annual growth rate. Now let's talk about their long-term growth targets. The targets on the right I pulled from a slide on their investor presentation, but they seem extremely aggressive to me, so take them with a grain of salt for sure. On the left are other targets of theirs that are still highly aggressive, especially their $25 billion in revenue in 2030. They're targeting a medical care ratio of 82 to 83% and an adjusted EBITDA margin of 67%, which is better than their competitors, and a long-term member growth rate of 30%, which is extremely impressive. On to the risks of Clover. First and foremost, they are currently unprofitable and do not plan to be until 2023. They lost $364 million in 2019, but only $22.6 million in the first half of 2020. but the 2020 numbers have had a huge benefit from COVID decreasing elective procedures and artificially improving their medical care ratio. They do have $733 million on their balance sheet, but I expect them to go back to bigger losses in 2021 and 2022 before reaching profitability in 2023. This means they may need to raise more capital, so there's definitely potential for some more dilution. Another risk is the deal does not go through here, and I'm sure of what the total effect would be on the shares, but the deal does seem likely to go through. Growth could also slow, but this seems unlikely considering the macro trends that are at play and the company's position. Finally, the biggest risk, as always, is can this company efficiently and effectively expand and take market share? Can they execute? If they can, they will be worth a lot more in the future. To wrap it up, Clover appears to have a superior technology stack that allows it to provide superior care and superior value proposition to patients. This will allow them to grow at high rates for years into the future, and their technology will allow them to have better margins than the legacy players in their space. Finally, direct contracting could present huge upside to this company and is what ultimately leads me to think they have 10x potential in the next 10 years. Thank you guys so much for watching. Check out my last video on Arcturus Therapeutics. Thank you so much for watching. Have a great rest of your day.